Hello and welcome. You're watching News Center and I'm Parikshit Luthra. In less than 10 days, the 26% reciprocal tariff announced by US President Trump on India is scheduled to kick in. Hectic negotiations are underway in Washington, D.C. as both sides aim to iron out the differences. When asked if the 9 July deadline could be extended, President Trump remained ambivalent, saying he could defer the deadline or even shorten it.
Is that July 9th date set for tariffs to snap back, or could there be a...
We can do whatever we want. We could extend it. We could make it shorter. I'd like to make it shorter. I'd like to just send letters out to everybody. Congratulations, you're paying 25%.
And Finance Minister Nirmala Sitharaman has said that India would love to have a big, good and beautiful trade agreement with the US, but not without riders. Speaking to the Financial Express, Finance Minister Sitharaman highlighted dairy and agriculture are red lines that India has drawn in the talks with US. The minister was reacting to US President Donald Trump's remarks that a deal could soon open up the India market. The Indian delegation has extended its stay in Washington for negotiations by 3 days till today. Abhimanyu Sharma has all the details.
Uncertainties over the economic fallout of reciprocal tariffs still remains as India and the US are still engaged in discussions for an interim deal and a bilateral trade agreement. India's trade delegation has extended its stay in the United States by a day, which has raised hopes for a potential interim trade deal with the United States. Last week, US President Donald Trump had indicated that a very big deal with India was likely very soon. He had also indicated that he would write letters to several countries the US is already negotiating trade deals with, and in case the deals are not negotiated before a certain point of time, those letters itself are going to substitute for trade deals. Now, it remains to be seen how early these negotiations are going to end and whether an interim deal would be signed between India and the United States. Now, concerns remain over several issues pertaining to dairy and agricultural products, in which the US has sought lower duties. It has also sought higher access, more access for GM crops, something which is being resisted by India due to domestic concerns. It remains to be seen whether there is going to be an interim deal signed anytime soon, even as Indian negotiators till now have made it clear, as per government sources, that any deal which would be signed should be a win-win situation and should not be signed out of desperation.
All right, let's move on. The US Senate has agreed to advance President Donald Trump's big, beautiful bill by a slim margin. The Senate will now debate the bill before a final vote takes place. The bill proposes $4.5 trillion worth of tax cuts and reduced spending on Medicaid, food stamps and other programs. As per an analysis by the Congressional Budget Office, the bill could add over $3.9 trillion to the national debt. The latest version of the bill reduces the tax on remittances to 1% in a major relief for the NRI community. An earlier version of the bill had proposed to tax remittances at 3.5%. According to RBI's March 2025 report, the US accounted for 28% of India's total remittances of $118 billion, which would amount to $33 billion in the financial year 2024. To discuss what this move means for NRIs, students and those working with their families in the United States, I'm now joined by Lloyd Pinto, partner, US Tax at Grant Thornton Bharat. Thank you very much for joining us on the show today. Lloyd Pinto, definitely a relief for people who are working there on work visas. But could you give us a sense whether this remittance tax impacts all categories of Indian visa holders in the United States?
At this point, yes. The only exemption earlier was for citizens. The current version of the tax applies to any remittances made by non-citizens outside the US. The good part is the Senate version of this bill has an exclusion for transfers that are made via banks and other accounts held at financial institutions, and also those funded via credit and debit cards issued in the US. So that's a huge relief. The earlier version had is simple tax on all remittances made outside the US, and that would have been a non-creditable tax, so it would have been an additional burden on any transfers that would have been made outside. The current version only applies to remittances where it is funded by cash or other similar physical instruments, but would not apply to transfers that are made and funded via US bank accounts and US debit and credit cards. So I think that's a huge relief for the entire NRI and other visa holders living and working in the US.
any possibility of refund as per the terms of this bill, and who all would be eligible if there is such a clause?
At this point, there is no ability to take a refund. It's a cost. So if it applies to any remittances, it would be an additional cost over and above the income tax that somebody would have paid on that income.
Have you been able to do any calculation as to what a 1% remittance tax would impact the flow of remittances from US to India?
At this point, we don't have any estimates on that, considering it's 1% vis-a-vis the earlier 5%, which would have been quite significant. I don't think it's going to be a major impact to individuals who have accounts with financial institutions. This could impact perhaps people in the informal trade, having cash balances and having to use cash to make remittances. But we expect that to be a comparatively lesser amount compared to the larger population that would have more formal channels of transfers.
Right. I would also like to ask you about the impact on Indian IT companies functioning out of the United States. What's the larger impact that you see there?
Yeah, I think a couple of provisions that are important to Indian technology companies who have operations in the US. One major provision is the BEAT tax, or the base erosion and anti-abuse tax of 10%. It was earlier, as per the earlier TCJA Act of Trump in 2017. There was a sunset at the end of this year, and that tax was supposed to go up to 12.5%. That tax has now been reduced to 10.5%. The Senate Finance Committee had a very interesting provision that they had released in the middle of June, where there was an exclusion for transfers or payouts made to offshoring entities where they are appropriately taxed or highly taxed. It is known as the high tax exclusion. Unfortunately, the final version of the bill does not have the high tax exclusion. So yes, technology companies who are expecting that relief may be a bit disappointed. So the tax rate benefit, yes, from a 12.5%, it's down to 10.5%. So that's the relief. But if there was a high tax exclusion as well, that would have been a much bigger relief to Indian technology companies.
Right. You mentioned the impact on Indian businesses, but overall, do you think this bill will make it less attractive to invest in the United States?
Overall, I think the provisions are a mixed bag. One of the more hotly contested and debated provision was the revenge tax, sort of the income tax version of the reciprocal tariffs that we saw on the indirect tax side. Fortunately, there has been negotiations with several countries, the G7 also trying to negotiate with the US. And the latest version of the Senate bill does not have the revenge tax or the Section 899 tax that we were talking about. This was supposed to apply to companies operating or headquartered out of countries which has what the US would call unfair taxes, like the Pillar 2 taxes or the diverted profits tax, like what the UK or the Australia has, or the digital services taxes. So those countries where you had these kind of taxes, the US wanted to retaliate and impose a higher degree of taxes on companies which are headquartered in these jurisdictions. But fortunately, the latest Senate version does not have the revenge tax included in the final bill. So that's, again, a positive for international businesses.
Right. I would also ask you about the further downside risks to the dollar. Do the changes to the bill address those concerns?
To some degree, perhaps, but I think with the major addition to the US debt, there could be definitely some impact on the exchange rates. As you mentioned, the Nonpartisan Congressional Office has predicted that about 3.9 trillion will be added to the US debt. So, of course, that is likely to have some impact on the exchange rates as well.
All right. We've run out of time, but thank you very much, Lloyd Pinto, for joining us with that update. Let's move on. The updated version of